Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with John Lear, chief economist at Morning Consult. Also, my Bloomberg colleague, Allison Schrager. She's also a columnist, senior fellow at the Manhattan Institute, and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We're here to talk CPI this morning. Your street expectation for headline CPI month on month is that it went up 0.4% seasonally adjusted in the month of December from the month of November. On a year-on-year basis, that would look like 2.9%. For your core, which excludes the volatile food and energy component, you're looking for potentially a 0.3% move from the previous month. And that would translate into a 3.3% year on year. A little bit more about the setup here. Investors and American families are pretty worried that inflation is settling in at a level that is a bit too high. We've seen bonds and futures markets basically price out any more rate cuts, at least until late 2025. Now, economists are broadly expecting this December data point to show that food and energy prices climbed meaningfully from the month prior, and the core measure, which excludes volatile food and energy, may show a bump from used cars and airfares. So we'll see in just about 4 minutes here. John Lear, what do you suspect is going on here? What is the big story that we should all be paying attention to?
I think the big story is we continue to have robust consumer demand, and there's no real reason to think that there'll be additional supply coming online, particularly when you look at that story that you highlighted in the food front. And so that's a story, again, of pretty strong growth relative to supply, which is going to drive inflation. I think that continues to be the story. We have persistently elevated inflation. The genie's out of the bottle, and this is likely our world for the foreseeable future.
Yeah, Allison, we go from one thing to the next. Sometimes it's used cars, sometimes it's housing. Maybe this month it's going to be eggs. But the big issue is inflation is still with us. This is probably a great environment in which to do tariffs, right?
Yeah, well, I mean, I'm told by the cabal that we're supposed to stop saying that tariffs increase inflation. They just increase the price level. Because we don't want to. Tariffs are bad for a lot of reasons, but if it's like, they're going to bring inflation and then they don't, then like no one believes us. They're bad for other reasons. So we've been told as economists from the cabal we're supposed to stop saying that. But yeah, it will increase the price level. It's not good. I mean, I think a couple of years ago, I did say that I expected we weren't going back to 2% inflation, not only just because tariffs, which I didn't know whether or not they were coming or not, but we are just there's structural things in the economy, including a pullback on trade, which we got in the Biden administration too, that, less trade with China, their economy is suffering, Europe's suffering, where it might just be an environment where inflation is just higher. And I'm with John that this might just be our new normal. And, before the pandemic, a lot of economists said they liked 3% inflation. The issue is, I think, largely for the Fed is like this whole inflation targeting thing doesn't seem like it's going well. Like for years, they couldn't hit their target. Now they're above the target. Like since we've had a 2% target, has inflation ever been 2?
Yeah. Yeah, it's been a minute, hasn't it? It's been a minute.
Never. Never.
Yeah, but coming back to what you said about tariffs, so we're talking. The latest is that maybe they're going to do a gradual thing. Maybe we'll do a 2% tariff increase every month. But that wouldn't really be a one-off price change, wouldn't it? It would be a regular price change, which is kind of like the definition of inflation, isn't it?
Well, also, isn't expectation? I don't understand why we would do that. Like, expectations are what matter. So if you see tariffs going up, whatever percent each month, it's effectively already 10. or whatever they're going to. I mean, I guess the happy story with that is that we wouldn't actually end up going to 10% because it's a negotiating tactic. Like, oh, we've put a little up. Oh, okay, I guess you're going to do what we want now, and so we're not going to go up higher. I guess
Hey,
that's
let me cut you off real quick, and we'll come back to that. The numbers are out, and we end up getting. So here, let me give you the positive news first. Core comes in a little bit soft, 0.2% month-on-month change in your core CPI. We had been expecting a 0.3. Now the headline does end up coming in bang on 0.4%. That was what everybody was expected. I'm guessing that some of those stories in the food space actually came true. We'll dig into that a little bit later. Translating all of this into your year-on-year numbers, you're looking at year-on-year CPI inflation of 2.9%, 3.2% on your core. John, let's go back to you real quick. Any immediate reaction of a year-on-year CPI slightly under 3% at 2.9%. It is a slight acceleration if you go by the year-on-year figures. What do you make of that?
I mean, I go back a little bit to what Allison said, which is, I mean, this is even close to 2%. And I think the thought that we were going to be on this glide path back to 2%, which is essentially, I think, the narrative that markets were trying to drive, and the Fed, I think, sort of followed that narrative. And that's led us to those pretty dramatic interest rate cuts over the last few months. In hindsight, that, in my mind at least, looks like that was the wrong decision, that we still have a really strong consumer-driven economy, and that is going to continue to produce above anticipated or above acceptable levels of inflation.
Yeah, Allison, back to you. What's your reaction, and go ahead and tie that back to what you're talking about with inflation expectations when I cut you off.
Yeah, I mean, I think what John said is like, this is just I mean, I guess the last mile was the hardest after all, or the last half mile. This seems to be sort of where, I mean, it seemed like a soft landing because we didn't have a big fall in employment. And that might have been just because inflation was high for a lot of like either demand reasons or supply reasons. And since those have abated, this is where we landed. And getting it to 2 might actually take serious harm to the labor market. So I think this administration going in, and certainly the Fed going in, is sort of going to have to see, like, can we just live with 3% inflation, or maybe we'll feel like happy with 3% inflation in a year's time. And I think the takeaway though is, inflation is back after like a 20-year hiatus. And this might just be part of our lives.
It's worth noting too, right, that 2025 is going to be the year of another review of monetary policy by the Federal Reserve. So I think that 2% target is very much in the crosshairs right now. It seems a little questionable to move the goalpost as you're in the middle of the game, but maybe there's a way that they can sort of spin the communication of that change.
Yeah, I will update folks real quickly on market reaction here. You do see the yield on the 10-year Treasury note moving down pretty meaningfully off the back of this number. We have been trading at about 4.76%. We're now down to about 4.7% and dropping. I would attribute that partially to the fact that yields have been moving up quite meaningfully, really since September. And folks were bracing for a little bit of heat in this number, even going into to today. Some of these things were foreseeable, namely the move in food at home, the move in energy, the idea that we would continue to see some pressure from used cars and trucks. I will, call out some numbers from the BLS report itself. You do see a 1.2% move month on month in December in used cars and trucks, somewhat foreseeable based on some of the wholesale indices that we track. You see a fairly meaningful move in energy commodities. We have seen crude moving up in recent weeks, albeit from a relatively low level, and that influences a whole host of sort of energy commodities and energy markets. I did want to call out. You see a slight move up in apparel. And finally, shelter. This is the overall shelter index, not just owner's equivalent rent. There's some other stuff in there, but you end up seeing a 0.3% move for the month of December, which is similar to what we saw in November. Shelter, famously, as we've talked about time and time again on this stream, is one of these sort of sticky components. We've talked about it a lot as a lagging component. The changes happen very, very slowly, sort of inertially in this category. And the fact that it has been slowing down and may continue to slow down could potentially be a good thing. John Lear, as we were talking about before the stream, and as you got into a little bit in the lead in, inflation expectations are so important. Inflation expectations are embedded in so much of the sort of economic orthodoxy around how you should do monetary policy nowadays. And you and your team and some folks from the Cleveland Fed have come up with a really novel way of understanding inflation expectations. So now that we have seen the number, and we know that we've gotten some strength out of supermarket components, we've seen some strength out of energy components. How do you expect this is going to move inflation expectations over the next couple of months?
I mean, expectation formation is a really interesting process. Michael Baber at the University of Chicago, I think, has done a lot of good work here. Energy prices and food prices do play an outsized role in that expectation formation process. We've done a lot of work, though, as well, looking at sort of the social media effects and thinking about how people's reliance on different news sources, in particular on Facebook connections and network effects, can in fact drive the expectations formation process. So that's kind of like the brave new world that we're in. I think more broadly, what we see is, to some extent, there's been this sort of disconnect between consumers and investors. And I think investors really expected inflation to be on this glide path. A lot of them expected this final, the last push, the final mile, to be easier than it has been. We haven't seen that from consumers. Consumers' inflation expectations, as we measure them every week, remain relatively elevated compared to where they were in 2021. And so I think that's sort of a disconnect. And I think in hindsight, it looks to me like the consumer was right, that inflation has continued to run hot, despite maybe all the narratives to the contrary from Wall Street.
Okay. Allison, can I ask you to try and lay out a dovish argument for us here? There's a lot of bad stuff that we can say, but the bond market is finding something hopeful in this number. What would be your dovish interpretation at the start of 2025 based on what we've seen and what we're seeing today?
Inflation's not getting worse, and markets are forward looking, and as I said, expectations are forward looking, and so the fact it's not getting worse, considering everything in the pipes, is not nothing, and something that maybe we should all be excited about. Also, as I said, core inflation is a little bit better, and that is what the Fed does make decisions on. And also, we were talking before we started about eggs. That was the dog that didn't bite. Food at home is not much worse than it was before, and that really matters to people. So, I mean, maybe bond markets are also thinking, well, we can live with 3% inflation. Maybe the Fed's going to come around to it. Maybe they're going to sort of sneakily change the target and then sort of start thinking it's okay to normalize at this rate. Considering, I even am somewhat optimistic about Trump's economic policy. Maybe I'm in denial of tariffs and deportations, but like I am a little worried about even if he does succeed and boost growth through corporate tax cuts and from deregulation, that could also be inflationary. If you recall, before the 20-year disinflation, we used to assume inflation and growth went together. So I think there's a lot of reasons to assume that we're going to have higher inflation under a Trump regime, even if he's successful, actually, because he's successful. So the fact that expectations of inflation are still seem to be holding where they are around 3%, that's nothing to sneeze at.
Yeah, totally. I want to come back to that, but I did also want to do a quick decomposition exercise for everybody and have you both weigh in on some of these components here. So I've got the month-on-month seasonally adjusted numbers up here on the screen, and just what I want to underscore from the start is we're still getting a lot of heat from sort of core services, which includes the housing component. Core services is up here in yellow, and as we break that down, of the 0.4% month-on-month move in CPI overall, core services is contributing about 0.16 percentage point, and of that shelter is about 0.1 percentage point. So figure of the inflation that we experienced in the month of December, about a quarter of it came from that shelter component, which again is not something that we want to ignore. It is real. Everybody needs to live in an apartment or have a house or something like that. But the market signals that we're seeing out there suggest that this is an area that has really cooled off and continues to be cool. And what we're experiencing is sort of a lot of lags in the process. Also within core services, one further thing I'll call out: transportation services contributing a little bit of heat this month. Take a quick peek under the hood there. So you do see some continued heat from motor vehicle insurance. I know a lot of people who have received notices from their car insurer or whatever that they've gotten a bump in the last 24 months. Also public transportation contributing in a big way. A big part of that is airfares. We knew that airfares were going to be kind of hot based on PPI yesterday, but this is also a volatile component. It's driven by energy prices. I wouldn't sweat it too much. All right, so let's move on from core services, and let's get over to food and energy. Okay, so your red bar is energy. Again, we knew this was coming. You could see it in like crude futures. You could see it in prices at the pump. It's not something that you want to ignore. It definitely affects inflation expectations, but it's also volatile. It's not really trending. And then final thing I want to call out for the month-on-month figures here is just this blue chunk. This is your food. And it's a pretty big contribution. So let's dig in here. Food at home in the orange, fairly big contribution. It was also a big contribution in November, and what I really want to do is just get in the weeds here and figure out how much that crazy egg story is driving this. And indeed, it's it's pretty meaningful. So we've got a category here that is meats, poultry, fish, and eggs in the pink, and let's see, all of this all of this pink right here is just coming from this crazy bird flu situation that we've been dealing with. So, you know, you can say that if you've been watching these streams, I'm a guy that likes to make a lot of excuses for inflation. And one month you hear me doing a riff on how it's just used cars, and another month you hear me doing a riff on how it's just owner's equivalent rent. And this month I'm doing my shtick on how a lot of it is eggs. Some of it, by the way, is also beef, other kinds of meats. You see this big contribution here in the orange from meat. I know that live cattle futures have been in a big bull market due to a drought. So I think you're seeing that playing through here. There is absolutely no guarantee.
Can I take the hawkish side of this? You're sort of presenting the dovish side.
That's why you're here.
Why you're here. I'm going to test my my extemporaneous skills here. I think what this shows, if I zoom out here, right? So this is an eggs issue, and maybe you talked about beef and other food issues, which certainly are going to be felt. My takeaway is that it shows the extent to which the U.S. economy and U.S. inflation remains pretty susceptible to supply side shocks. And so as I think about all the ways in which geopolitical uncertainty, trade uncertainty might affect the U.S. economy, this to me is a signal that we are actually very vulnerable to some of those shocks going forward. My hope is that that doesn't materialize, but I think it shows that the demand feature is there. We have positive real wage growth, and it doesn't take a whole lot to have a shock on the supply side that's going to drive prices higher.
Yeah, because in theory, if egg prices go up, you'd find a substitute, right? And
what would that substitute be?
Fake eggs, soy products. There's protein options out there.
All right. So
also,
okay,
I'm also like want to pile on further here with shelter. Like, I feel like we keep saying, well, shelter's going to go down and then all of our problems will be solved. But like, I don't see shelter costs going down in 2025. I mean, you have things like insurance, mortgage rates aren't going down. That all feeds into, even if it's owner occupied rent, those costs. So
I couldn't agree more. I think in hindsight, we will look at all this and say all of our models are wrong. There was a structural break in the economy where people were working from home more, moving more into these exurbs, and that there was just basically a level shift in the demand for housing. And that's the world in which we live.
But empirically, the numbers are coming down, right? I mean, the trends from the likes of Zillow and these guys are undeniable, and the trend has been looking better in the very numbers that are in front of us, right?
It's the same as last month, 0.03. And no, yeah. I'm just saying as well. The outlook is not good for 2025. Like, I don't see anything in the economy that suggests that shelter costs are going to go down. Although John Arnold had an interesting tweet the other day arguing that house prices were going to collapse in 2025. So.
Right. Well, I mean, the question is, like, it feels like we have a lot of momentum, but there are some areas of clear vulnerability. Like, is this? So everything that has happened has affected expectations in the bond market, and with bonds doing what they have, we now have 30-year mortgages back above 7%. And so one question is that actually a sustainable equilibrium for the housing market? And, a lot of people think it's an oversimplification, but, there's a saying that the housing market is the economy. If housing prices really start to roll over, what does that mean for all sorts of other things, including rents and stuff?
Like 20 years ago, people would have thought 7% was a great mortgage rate. I mean, it is like
in 1985.
Yeah, people would kill for that. Like, if you think about it, like it's crazy that you could get a 30-year fixed rate consumer loan for 7%. I mean, only with all of the sort of government intervention that we do in the housing market does that even exist. It should be much higher in theory.
Yeah, it still feels pretty brutal though when run-of-the-mill 4-bedroom in California is $1.5 million.
I mean, I think it's been surprising. We had the highest or the most rapid hiking cycle in Fed history, and it didn't break the housing market. And I think that to me is a sign of the underlying demand for housing that is built up. And I don't see that sort of going anywhere.
Yeah, definitely. And to your point, Chad, I mean, I remember 2022 when there were a lot of housing doomers out there on Twitter and so forth. As far as I can tell, every one of them was proven terribly, terribly wrong. So if we're going off of recent experience, yeah, this housing market can take a lot. Sorry, Allison?
Well, maybe not, because I keep talking to people who were waiting for rates to go down. They didn't go down. So they all got adjustable rate mortgages, and they all tell me it will be fine in a couple of years when mortgage rates go back down. It's even in their projections. And maybe, I hope people are dependent on that. It could happen, but it might not.
All right. So let's bring all of this home here. We got, in some ways, a slightly better than expected number today, but I am on the line here with two folks who seem relatively concerned that inflation is settling in here. The market thinks that we're not going to see much in the way of Fed cuts, at least until later in 2025. What do you guys think all of this means for monetary policy with these new numbers in hand? John, what do you think?
I think we'll see a hawkish pivot. I just think, we're in a really dangerous spot in some sense, which is to say that inflation has come down, but not down to the target. So now we're in a phase where real wage growth is positive. Inflation isn't actually sort of sucking the lifeblood out of the consumer. It's just kind of, kick the can down the road. And so it's hard to see sort of what event might come. And maybe it'll come in the form of a negative supply shock or something like that. But it's hard to see what is going to happen in the foreseeable future that's going to bring inflation back down to target.
Sure. Allison, what do you think? And by the way, just a market update. We now have yields on the 10-year down to 4.69, almost 4.68 from 4.76 when we started the live stream. So some encouraging moves in the market. But what do you think it means, abstracting from the noise here?
I mean, this is a very risk-averse Fed. I think they're looking for any excuse to cut because I think they're anxious to declare victory on this bout of inflation. But it just seems like the data keeps coming in that's giving them reasons to sit and wait. So I imagine they're going to sit and wait until a sort of shock comes along. And I think there's a good chance some shock will come along this year that will give them an excuse to go in either direction. But I think for now, they're just going to stay in a holding pattern. And if they do get a couple of good data reports, that they're going to be cut as soon as they can.
Okay. All right. Now I'm going to tee you both up for one final point here. A key question is always, okay, are we in inflation fighting mode? Yes or no? Okay, you get the answer to that question, but then the subsequent question is: once you win the sort of inflation war, where are you going? Where are you going to settle things in? What is the so-called neutral rate for monetary policy, where you're neither restrictive nor are you sort of helping along the economy? The latest New York Fed survey of primary dealers suggests that the long run neutral rate, where we're going to settle in, is around 3.1%. That's a little bit higher than what surveys of Fed participants.
Is that real or nominal?
That is nominal, 3.1%. So realistic or bogus, Allison?
That's bogus. I mean, if our equilibrium interest rate, inflation rate is 3%, then they're saying our real neutral rate is 0, which is what it was pre-pandemic. And we are not going back to that world. So I think this is victory. I think we are there. I think this is, where inflation just is in this economy, and the Fed is going to have to, wants to bring down lower, might actually have to harm the labor market. And if inflation is higher, then our star is also higher. So, I'm not sure if where the Fed funds rate right now, it doesn't seem to be causing a lot of damage to the economy, but that could be for a lot of reasons. So we might just have to accept that this is what victory is, where victory is, and our star is higher, and definitely higher than 0.
All right, John Lear, our star. What's your take?
It's interesting. I mean, that number is basically what the incoming administration has forecast for GDP growth. So essentially, they think that interest rates and growth are going to come back and mirror each other. I guess similar to Allison, I think we are operating in a world where our star is higher, certainly higher than it was before. Making a guess, I mean, I think you can say directionally where it's headed, but putting a point estimate on our star is sort of doomed to fail. I think you can see it in a lot of the estimates that come out and how unstable they are over time. But when you think about the excess demand again for housing, you think about sort of the ways that the pandemic has shaped the economy. It feels to me like an economy where interest rates are just going to be higher for longer.
All right. Well, listen, I'm on with a couple of higher for longer folks here, so I've got a tough sell to close on a positive note. But I will say this: 10-year Treasury notes rallying on the back of this. To me, it looks like all we have to do here is create the strategic chicken reserve, and we've got this problem. We've got this problem solved. I'm kidding. Your inflation in the United States of America comes in month on month at 0.4% change for the month of December, but you do get a little bit of encouragement on the core with your ex food and energy coming in at just 0.2%. Thank you very much for joining us. Thank you to John Lear. Thank you to Allison Schrager. And we'll be back for some more of these next month.